The US dollar is not just facing a crisis, it's spiraling into an unprecedented financial storm. As the dollar weakens, many will soon realize they've been holding on to the wrong investments. But the real question is, how did we get here, and where do we go from here? The US economy is in a fragile state, and the most concerning factor isn't just the dollar's devaluation, but the broader instability caused by poor fiscal policy. The US government is running on borrowed time and money. To keep the system afloat, Besson is making a drastic move, dismantling banking regulations. These changes allow banks to buy more US treasuries, essentially using Wall Street to fund the government's growing debt. While this sounds like a solution, it's a dangerous gamble that risks the whole financial system's stability, reminding us of the 2008 housing crisis. Let's simplify this. Besson wants to make it easier for banks to hold US debt by lowering the capital requirements. This means banks will be encouraged to buy more US Treasury bonds, creating an illusion of stability. However, the real issue lies not with the banks, but with the US's fiscal management, which is spiraling out of control. In just 3 months, from July to September, Besson borrowed over $1 trillion. That's an overwhelming amount of money, and the tariff income simply isn't enough to cover it. Meanwhile, investors are beginning to question whether they can keep lending to the US, as they fear a potential default. The debt crisis is not just about numbers, it's about global trust in the US. Scope, a major European ratings agency, just downgraded the US credit rating from AA to AA-. That might seem minor, but in the world of finance, it's a significant shift. This downgrade affects how the world perceives the US. Will the US pay back its debts, or are we headed towards a default? This uncertainty makes the US less appealing to investors. In fact, countries like Sweden and Norway are now considered more trustworthy than the US. If this situation worsens, the US will have to increase yields on Treasury bonds to attract investors. But the more they raise the yields, the deeper the debt pile grows, making it increasingly unmanageable. Even investors like Warren Buffett, a staunch US market supporter, is starting to panic. The dollar's continued collapse will hurt bondholders the most. Bonds are based on the underlying assets of countries, and as their value decreases, so does the bond's value. For US investors, it's not just about losing nominal value, it's about the erosion of purchasing power. As the dollar weakens, everything from groceries to goods at major retailers will become more expensive. The dollar's decline isn't just theoretical, it's already happening. Major banks are predicting a further drop in the dollar's value by 2026. Morgan Stanley anticipates a 5% drop in the first half of next year. While the Fed is attempting to cut interest rates to manage the national debt and support the stock market, the global situation is far from synchronized. The US's actions are disconnected from what's happening around the world. The US needs to cut rates to manage its financial obligations, but other central banks are not doing the same. Inflation is becoming a global issue once again, largely due to Trump's tariff policies, and this disconnect is pushing the dollar lower. Adding another layer of complexity is Japan's rising economic power. The Bank of Japan is preparing for a significant rate hike. While this might sound small, only 25 basis points to 0.75%, it's the highest rate since 1995. This rate hike could have serious consequences for the US dollar. A stronger yen could prompt Japanese investors to flood back to their local markets. They might start buying Japanese government bonds, JGBs, and local stocks, creating a shift of capital out of US assets. Furthermore, Japan's yen carry trade, where investors borrow cheap yen to invest in higher-yielding US dollar bonds, is unwinding. This trade has been profitable as the yen fell and the dollar rose. But as Japan strengthens the yen, this trade may reverse, putting even more pressure on the US dollar. This is a lot to digest, but the reality is the US dollar's future is uncertain, and things are getting worse, not better. As we move further into 2026, the global financial landscape will likely look very different, and the US might not be at the top of that list anymore. Since 2025, the yen has been steadily gaining strength against the US dollar. What was once over 160 yen per dollar has now dropped to 140, with fluctuations around 150. The primary reason behind this shift is the Bank of Japan's, BOJ, recent rate hike. Typically, when a country raises its interest rates, the value of its currency strengthens because it provides better returns for investors. As the BOJ increases rates, the yen becomes more valuable relative to the dollar. Meanwhile, the interest rate gap between U.S. Treasuries and Japanese government bonds, JGBs, has been closing. Before the Fed's rate cuts, this difference was over 4%, but now it's only 2%. This is a significant decrease, making U.S. bonds less attractive to investors, particularly those involved in the yen carry trade. The yen carry trade involves borrowing yen at a low interest rate and investing in higher-yielding U.S. dollar assets. With the yen strengthening and the dollar weakening, many investors are starting to lose money. If the dollar falls by just another 2%, those holding the yen carry trade will find themselves in a losing position. This shift in the yen's value could lead Japanese investors to repatriate their dollars back to Japanese markets. If that happens, it could trigger a large-scale unwinding of the U.S. Treasury market, putting additional pressure on the dollar. Furthermore, Japan's ongoing inflation problems may require further rate hikes to control prices. One rate hike might not be enough to curb inflation. The BOJ could raise rates further, potentially up to 1.25%. If inflation remains high, rates could even reach 2.5%. These higher rates in Japan could have severe consequences for U.S. assets. We've already seen the fallout in U.S. tech stocks, which have been hit hard by the rising rates and potential outflows of capital. The U.S. tech sector, which has been growing rapidly, is especially vulnerable. The recent drops in companies like Oracle, which fell another 5% and is now 50% below its record high, are signs of what could come if more money leaves the U.S. Investors are growing concerned that companies may struggle to finance their debt, and there's a real chance of defaults in some cases. As Japan pulls capital out of the U.S., bond yields in the U.S. could either stay elevated or even rise, making it harder for U.S. companies to finance operations. The cost of building critical infrastructure, like data centers, will also rise, which will be a burden on many industries. Despite the turmoil in the U.S., China is moving away from the dollar and diversifying into more secure assets, particularly gold. Over the past few months, China has been reducing its large stockpile of U.S. bonds. While China helped the U.S. during the 2008 housing crisis by absorbing U.S. debt, there's now no incentive for them to continue doing so. In fact, given the ongoing economic tensions, it no longer makes sense for China to hold bonds issued by a country they see as an adversary. Instead, China has been significantly increasing its gold reserves. In 2025, China announced that it bought 25 tons of gold, but many experts believe they purchased far more, possibly 250 tons or even more. China's real gold reserves are estimated to be over 2,300 tons, though some analysts believe the figure could be as high as 5,000 tons, or even double that. China's strategy involves purchasing gold through various channels, often avoiding reliance on Western exchanges like the LBMA, COMEX, and Switzerland, which are dominated by the G7 and France. China's gold accumulation strategy is not limited to buying from global markets. Instead, they are securing control over the entire gold supply chain. China's CMOC, a major mining company, has recently acquired gold mines in Brazil for billions of dollars. CMOC is one of China's largest mining companies, and it mines everything from copper to cobalt. The company is partially state-owned, which means the Chinese government has influence over its operations. Buying mines in Brazil isn't just about acquiring resources. It's a strategic move to increase China's influence in Latin America. CMOC had previously purchased a Canadian company to mine gold in Ecuador, another Latin American country. This pattern of acquiring mining assets in Latin America is no coincidence. Beyond the geopolitics, China's control over gold resources is important because the more gold China accumulates, the more influence it gains on the global stage. This accumulation of gold could be China's strategy to break free from the U.S.-dominated dollar system. By securing gold through direct ownership of mines and stockpiling gold reserves, China is positioning itself as a key player in the global financial system, possibly challenging the U.S.'s economic dominance. China's gold discovery spree is only intensifying. In November, the Chinese government announced a significant gold find in Liaoning province, further increasing their stockpile of this precious metal. This massive acquisition of gold, along with China's growing influence in Latin America and its push for greater global economic control, indicates a significant shift in the balance of power away from the U.S. The more gold China controls, the harder it will be for the U.S. to maintain its dominance in global finance. The deposit itself is enormous. We are talking about an estimated 1,400 tons of gold sitting in one place. At current prices, with gold trading above $4,300 an ounce globally, that translates to well over $170 billion in value. That is not a marginal discovery. That is a strategic windfall, especially at a time when gold prices are already elevated and global demand is rising. At this point, China's strategy should be very clear. They are using fiat currency to acquire something tangible. In simple terms, they are printing or deploying paper money to dig real wealth out of the ground. While the U.S. continues to debase the dollar through debt expansion and monetary easing, China is doing the opposite. They are steadily converting currency into hard assets, with gold sitting at the center of that plan. Controlling the gold supply chain gives Beijing a major advantage. It is not just about owning gold bars. It is about owning the entire ecosystem around gold. China is already positioning itself as a global storage hub for physical bullion, helping foreign central banks store their gold. That alone shifts financial gravity away from traditional Western vaults. But that is only step one. The next step is financialization. China is building out its domestic gold ETFs. In November alone, investors poured more than $2 billion into Chinese gold ETFs, adding another 17 tons of physical gold into their vaults. This matters because ETFs are how modern capital accesses gold at scale. Whoever controls the ETF infrastructure controls the flow of institutional money. Right now, most well-known gold ETFs like GLD and IAU are Western-based. Their gold is stored in New York and London. That means Wall Street and Western financial centers sit at the center of global gold investment. China is actively trying to break that structure. By growing domestic ETFs backed by gold stored inside China, they are creating an alternative system that does not rely on Western custody, Western exchanges, or Western regulation. This is why buying gold mines matters so much. Local discoveries and foreign mine acquisitions feed directly into this system. The more gold flows into China, the larger their ETFs can become, entirely independent of the West. Capital that might have gone into Wall Street products instead flows into Shanghai. Over time, that starves Western markets of investment while strengthening China's financial base. Even if the West tried to respond by restricting gold exports to China, it likely would not work. We have already seen this play out with rare earths. Once supply chains are secured at the source, embargoes lose their power. The U.S. is already stretched thin dealing with debt, inflation, geopolitics, and industrial decline. Gold is just one more front, and it is not one they are leading on. So the real questions now are forward-looking. Does Japan's rate hike accelerate stress in U.S. markets? And does China continue doubling down by buying even more gold mines around the world? Let me know what you think in the comments. Stay safe, smash the like button, and subscribe as we navigate through these crazy times.